Hello, and welcome to Reflections on Investing with the Cornell Capital Group. And today we're going to talk about something we haven't talked about much at all in the last 2 years, and that's fixed income. And why haven't we talked about it? There are two answers: return and risk. But before going into that, I should point out that we did do several reflections on the relationship between interest rates and inflation. And I highly recommend those because interest rates are rising and inflation is taking off. And I think you would find the sessions instructive. But today we're going to talk about fixed income as an investment. And at the Cornell Capital Group, we're starting to think about it again. But we aren't there yet. Let me explain why. Recall what a fixed income investment is, as opposed to equity, where a company issuing the equity makes no promise about what you're going to get from your investment. A fixed income investment is called fixed income because through a legal document called the indenture, the company promises to pay specific payments to the investor. And if the company fails to make those payments, the investor can put them into bankruptcy. Now, the word promised is important there. If AT&T makes a promise, if Apple makes a promise, or if the federal government makes a promise, that's one thing. If a company in financial distress, a cigarette company, makes a promise, that could be quite another thing. And the distinction there is between what is called high-grade or investment-grade debt and low-grade or junk debt. Today I'm going to be talking about high-grade fixed income investments. So we'll focus on that. Now, a moment ago I said the two reasons that we haven't talked much about it are return and risk. And let's start by looking at return. And what we're going to look at here is the yield on what is probably the highest grade investment, a U.S. Treasury investment. And in particular, the 10-year constant maturity U.S. Treasury, which is the highest grade investment and very closely followed. So on the screen now, you can see how meager the returns have been on 10-year Treasury bonds. They've been below 1% much of the time, below 1.5% all the time, until just recently, where they've risen to 2.5. Now you might say it close to 2.5. Well, that's a good investment. But here's the problem. You get paid 2.5% on your money, but you get it in future dollars. If inflation is running at 7%, those future dollars are worth 7% less. So the real return on your investment is significantly negative. That's why at the Cornell Capital Group, though we're starting to entertain fixed income investments again, we still don't see them as sufficiently attractive. Now, turning to risk, you'd say, well, there's no risk of a 10-year fixed income investment if I put my money with the U.S. Treasury. Well, that's only true if you hold it all 10 years. And here's the problem. Suppose you bought a 10-year Treasury when the yield on it was 1%. And now it's 2.5%. Well, because of the higher yield now, the price of the original bond falls. And in fact, you can calculate that it would have fallen about 14%. So if you bought a 1-year Treasury last year, you're now about 13% underwater, 14% minus the 1%. And because at the Cornell Capital Group, we fear that interest rates could rise a good deal more, that risk remains. So what's the bottom line? When it comes to fixed income, we're now willing to take another look. But we don't think things are attractive enough to recommend significant investment. This has been Reflections on Investing with the Cornell Capital Group.